Signal, not noise.
This whole series comes down to one question. Is this price reasonable? Not is it going up, not is it popular. Is the price reasonable? This episode covers two tools, and both start from earnings. P tells you what the market pays today for every dollar a company earns. PEG tells you whether that price is justified by the growth people expect. And watch out for one word: expensive. On its own, it means nothing. Expensive next to what? Its earnings, its growth, other companies. Every comparison is a different tool. Today, I hand you the first two. Price over earnings per share. It's right there on the card. $150 price, $6 of earnings, give you a P of 25. Consider the price that comes from the market quote, and the EPS comes from the income statement. In plain terms, you are paying $25 for every dollar the company earns. Put another way, at today's earnings, it would take 25 years to earn the price back, unless earnings grow. And that unless is the whole game. Here is something that catches people out, and it isn't on the card. There isn't one P, there are two. Trailing P, using the earnings already reported. Forward P uses what analysts expect next year. Always check which one you are looking at. For a fast grower, they can be worlds apart. Now the strength. P works across almost every sector. It has a long track record, and everyone understands it. The limit is that earnings are softer number than they look. The accounting rules let a company nudge them upward. It can spread the cost of its equipment over more years. Book a sale a little early. Park an odd cost in a one-off bucket that people ignore. None of that is fraud. It's all within the rules. And yet, it can make the profit look better than the business really is. On top of that, P is useless when there are no earnings. So most young loss-making company don't have one at all. And it's blind to debt. Two identical P can sit on completely different balance sheet. The last one is the next slide. Here, how you actually read a P. It's the market's expectation, not a verdict. You have to accept. A low P, like the 8 on the left, is the market signaling doubt. It expects little growth. A high P, the 35 on the right, is the market paying up for growth it believes is coming. So the question is never just cheap or expensive. It's whether you agree with that expectation. Too pessimistic on a low P, that's an opportunity. Too optimistic on a high P, that's a warning. And the trap on the left has a name, the value trap. A stock looks cheap on a low P, you buy, and it stays cheap or gets cheaper because the market was right to adopt. A low P isn't a discount by itself. Sometimes it's a decline you haven't spotted yet. Picture buying a lemonade stand. It earns $10 a year, and the owner wants $250 for it. That's a P of 25. You are paying 25 years of earnings upfront. Is that worth it? It depends entirely on how fast you think the stand will grow. And there's a hidden assumption buried in those 25 years. It only holds if the stand never grows and never shrinks. But nobody buys a business expecting it to stand still. That's exactly why the next tool exists. PEG. It prices the growth in. Here's the trap. Same P means debt risk, right? Two companies, both at 20 times earnings, both carrying the same debt, so they must be equally leveraged. That's the assumption, and it's wrong. P does not see debt, but only part of it. A company pays interest before it gets to earnings. So heavier debt drags earnings down and pushes the P up. That part shows. What P can see is the shape of the debt. When it comes due, whether there are covenants, clauses that can force early repayments at the worst possible moment, and whether the debt is offset by cash. 10 billion owed with 9 billion in the bank, it's really 1 billion, not 10. Take two companies. Same P of 20, same 20 billion in debt, identical on paper. Company A doesn't have to repay for 20 years. Company B has to refinance next year. And here's the thing. Companies almost never repay debt in cash. They roll it over, borrowing again to clear the old loan. So B has to raise 20 billion all over again next year, and whatever rate the market feels like charging. If rates have jumped or lenders have pulled back, that's the same debt suddenly cost far more. Or B can't raise it at all. Same P, same debt, and one of them is a single bad year from the edge. P sees neither. P told you what you pay for today's earnings, but it says nothing about tomorrow. A P of 30 sounds expensive until you hear the company is growing 30% a year. PEG is the fix. It's the P divided by the growth rate. 30 over 30 gives you 1.0. One quick note on that growth rate. It isn't last year's growth, it's the expected future growth. Usually the analyst consensus for the next few years. And the moment you use PEG, you have imported someone's forecast into your valuation. All that though. So, a P of 30 with the 30% growth is a PEG of 1. Fair. You are paying in line with the growth. The same 30 with only 5% growth is a PEG of 6. Expensive. The price didn't move, the growth did. A IP is only expensive if the growth underneath it doesn't justify it. PEG flags the expensive slow growers that P waves through. And it lets you compare businesses at completely different growth stages. A young firm at 40 times earnings, growing 40% as a peg of 1. A mature firm at 15 times, growing 5% as a peg of 3. P alone can tell you which one is more expensive for its growth. PEG can. But PEG is only as honest as the growth estimate. And analyst forecast lean optimistic. There's even a name for it, analyst optimism bias. The reason is structural. A buy recommendation brings in trading commissions and banking mandates. A sell irritates management and costs the analyst access to earnings call. Buy rating outnumber sells by roughly 5 to 1, and estimate set in January get quietly revised down by December, which is why companies so reliably beat consensus. One last thing. PEG breaks completely at 0 or negative growth. PEG catches what P misses, the slow grower that looks cheap on earnings alone. A utility at 16 times earnings growing 3% as a peg of 5.3. A tech company at 35 times growing 35% as a peg of 1. The utility looks cheaper on P, but once you price in the growth, it's far more expensive. The rule of thumb comes from Peter Lynch. A peg under 1 is attractive, but use it as a filter, not a verdict. A peg of 0.9 built on a forecast nobody can defend, worth less than a 1.2 you actually believe. Because the weakness is always the denominator. Analyst growth forecasts run high more often than low. When the forecast is inflated, PEG ends you false confidence. So, before you trust it, ask one question. Where does this growth number come from? And if it comes in at half the forecast, does the PEG still hold up? That's the stress test. 2 restaurants, both earning $100,000 a year. The first one, restaurant A, is priced at $1.5 million. That's a P of 15. On the face of it, cheap. Now, here's restaurant B, priced at $3 million, a P of 30. Twice as expensive on paper. But watch what happens when you bring in growth. A is growing 5% a year, so its PEG is 3. B is growing 30%, so its PEG is 1. The one that looked expensive is the fair deal. The one that looked cheap is the expensive one. And this is why sorting stocks by lowest P, the classic bargain hunt, barely works. Half the names at the top are cheap, for a reason. PEG is the second filter, the one that separates the real bargain from the traps. Here is the tempting belief. A PEG below 1 means the stock is undervalued, that you are getting growth for free. But PEG is only as honest as the growth estimate behind it. And 2 blind spots hide inside a low number. First, a PEG of 0.8 on 40% growth is still a P of 32 today. If that growth never arrives, 32 times is simply what you overpaid. Second, PEG treats all growth as equal. Steady, Repeatable compounding and lumpy one-off spike get the same score, and they are nothing alike. Take a cheap company. P of 25, analysts forecasting 50% growth, so a peg of 0.5. Looks like a gift. But that 50% is a one-off supercycle, already at its peak. The next year, earnings fall 30%. Peg said buy, the cycle said wait. The maths was right, the input was wrong. So always ask where the growth number comes from before you trust the peg. So, what do you actually walk away with? Two tools, two angles on the same question. P tells you what the market pays for each dollar of earnings. PEG tells you whether that price is justified by the growth people expect. Together, they aren't a buy signal. They are a starting point. They tell you what the market believes and then force you to decide whether you agree. And notice that both of them rest on earnings. But earnings can be dressed up through the depreciation choices, revenue timing, one-off charges. So next, we go to the metrics that cut through the accounting entirely, the cash flow multiples. What actually landed in the bank and what you are paying for it.
No guessing. Your call.